Okay, excellent. Now that we are all online, William, you can hear me?
Yes, loud and clear.
Okay,
Okay.
excellent. Good afternoon, everybody. Better late than never. We have our final digital assets webinar for 2025. It's been quite the year. We have swung from tremendous optimism and some concern. We've had major breakthroughs in terms of regulatory developments, particularly with respect to the passage of the US Genius Act, which added massive momentum to the uh, stablecoin space in particular, but in general, Trump administration is seen as light touch on regulation, and therefore crypto assets, by and large, have been considered to be treated very favorably by this administration, not least the President of the United States and his family. What we will do in today's presentation first take stock of the recent sell-off. William will go over the market developments of the last couple of months in particular, where we've seen some fairly sharp sell-off. And we run these correlation exercises where we look at risk on and risk off assets. We look at hedging behavior. We try to understand where crypto as an asset class is heading in terms of being a hedge or a risk on asset. I think it's almost like a rhetorical question. I think most people who are attending this call know the answer, but William will show some analysis around that. And also, what are the additional drivers in the whole crypto sell-off that we have seen lately? We will touch on regulatory developments on both the stablecoin and the CBDC space, but the special feature this month or this quarter is the whole quantum phenomenon. I mean, ever since I have been working on the entire uh, ecosystem of blockchains and crypto, this question has always lingered that the cryptography-based solutions that make the blockchain work and secure, can that be undermined by future disruptions in the world of cryptography, particularly coming from quantum computations? I must say, a lot of us talk about these things, but we don't really understand that. But it is critical and important to at least get the sense of the implications of that. And that's what we will try to do through the course of this webinar as well. All right, so that's the gist of today's presentation. The chat box is there. Feel free to write your questions. We'll keep an eye on them and take them as the event progresses. But also, William, this is a QR code for Pigeonhole, or this is a QR code for the report?
For the report.
Yeah, good. I've also put the HTML link in the chat section. So to those who are interested, please take a look at it and download it. But in the meantime, listen to what we have to say. William, why don't you take it away? I believe at some point Radhika was traveling through India, will dial in and join this presentation as well.
Yes, thank you very much, Timer. So Radhika will be joining us later on. So for my part, I'll be discussing, this huge amount of volatility that we're seeing in crypto markets over the last um, two months. What are drivers behind it? Do we see an end to that sell-off, right? So that's the question that we have gotten so many times in the last 1 or 2 weeks. So I think it's perhaps a good time to kind of do a review of how crypto has been performing over the last 6 to 12 months, and then get a sense of what the market is worried about. So, um, starting from, I guess, when Trump was elected as president, there was a huge rally in crypto markets, right? So, a lot of positivity around the US being the new crypto capital of the world, a lot of positivity over the Genius Act. Um, which is seen as really validating blockchain technology to be used in the new modern infrastructure for payments, right? Which is basically stable coins. But at the same time, there has also been, concerns, sharp drawdowns. For instance, in January earlier this year to April, we have seen the Bybit hack happening. That really hit sentiment in crypto markets. And also at the same time, there was also the Liberation Day terrorists in April. So if you look at the sell-off in Bitcoin, yes, it has been quite severe. We've seen a drawdown about 30%, but by and large, it is kind of in line with the earlier sell-off at the start of the year when there were concerns over market volatility due to Trump tariffs. There were concerns over the implications of the Bybit hack, so on and so forth. So um, um, it is what it is. Crypto markets are volatile. There's always going to be a new unexpected driver that has moved markets. But I think I would just touch on what we think are three major drivers that have recently driven this sell-off. So I think the first want to mention is really 1010 liquidations. So that happened on 10 October when Trump announced that he wants to raise tariffs on Chinese goods in response to Chinese threats to control rare earth exports. It triggered the largest wave of crypto liquidations in a single day, right? So since then, we have seen about 1.3 trillion of losses in crypto market cap. Very similar, again, as I mentioned, the magnitude seen from Jan 25 to April 25. So it's not totally out of whack from what we've seen in the past. So what happened on 1010? There is this chart over here which shows the amount of liquidations, which is essentially the amount of trades that were forced to close because of margin calls. And you can see that it's just a huge number that happened on 1010, right? So it's about 1.19 billion worth of crypto liquidations. It's pretty much a record day. No other uh, uh, days have seen this amount of liquidations. And if you look at it, actually, is not just what's happening across Bitcoin and Ether. Of course, Bitcoin and Ether being the largest cryptocurrencies with the highest market cap, they've seen very significant liquidations, about 4.6 billion of longs for Bitcoin, 3.8 billion of longs for Ethereum. But also, if you add them together, for all the other altcoins, the amount of liquidations is very close to what we see in Bitcoin Ether. So the crashes, you can imagine, was very sharp for altcoins because their market caps are so much lower. The amount of liquidations relative to their market cap is so much smaller. So so much larger. So that really, I think, really blunted speculative impulses. So there were many investors who were burned because of this episode. We've seen that really, I think, reining in some of the speculative sentiment that we've seen in crypto markets actually for the better part of this year. But a point to note is really Bitcoin Ether has also shown a degree of resilience that I think comes as a surprise to quite a number of people because despite this record day of liquidations, if you look at the max drawdown, the max single day drawdown for Bitcoin is only about 14%. For Ether is about 20%, and they're way smaller compared to the other altcoins. For instance, we compare with Ripple is down by close to almost 50%. And if you look at the price action on an intraday basis, so after 1010, it was the weekend. Futures markets don't trade, but on the when markets open on Monday, you could see actually a bit of a recovery in Bitcoin Ether when they narrowed the gap with S&P 500 futures. So you can see that pricing um, um, shows a degree of resilience. I think that underscores the fact that both Bitcoin and Ether markets are very mature. They have very high liquidity, very deep markets due to higher level institutional participation. So even though we have a very seismic amount of liquidations in crypto markets, a very large pullback from I would say retail investors because of the sharp losses, Bitcoin and Ether markets still largely continue to function uh, function without too much losses. But then that was then. So now, as we look at what happened since the 1010 liquidations, we see there are two additional factors that have driven crypto. So starting from November, we have seen a little bit of concern from markets over what's happening in the tech sector, particularly around circular investments between AI companies and hardware companies, record valuations, a very high degree of bond issuance by hyperscalers as they try to raise funding to invest more in AI infrastructure. So there was some chatter that it could be a bubble, some degree of correction could be happening. We see Nasdaq actually correcting somewhat since the top of November. And that, I think, is the second leg that really weighed on crypto markets. There was a bit of tentative recovery, but given the traditionally high correlation between Nasdaq and Bitcoin, so you can see this chart over here as well, essentially very straight one-to-one correlation, we say, between Nasdaq and Bitcoin returns. No surprise that really dampened, I would say, crypto market sentiment. Second time, we see a more significant correction in crypto markets after that, where Bitcoin traded below the 100K level. The second issue that has also come is a potential risk is really to do with the so-called digital asset treasury companies. So these are listed companies where they have shifted their business models from rather mundane businesses into more exciting world of digital assets, where they're using their balance sheet to acquire Bitcoin, they're using it to acquire Ether, and in return becoming some kind of proxy for investors to bet on digital assets, right? So what that means is that in effect, the business model is quite different from when they were first listed. And MSCI, which is one of the major equity index compiler, is reviewing right now whether or not they should continue to include these digital asset treasury companies under their indices, because they could be rather um, they could be classified as investment funds, which should be excluded from these indices. So this review is slated to is ongoing. It's slated to end by 31st December this year, and the results will be published by January 16. But already you could see a very significant market movement in response to that potential rule change, right? So MSCI indicated that 39 listed companies or DETCOs could be impacted by this rule change. You see the valuations of this DETCOs actually coming off quite a bit since then, right? Because if passive funds are no longer um, invested in this DETCOs because they're excluded from the equity indices, then that means valuations could suffer to some extent. So we've seen some of the large DETCOs where previously they were trading a premium to their Bitcoin holdings or their Ether holdings. Now that premium has narrowed to almost zero, even perhaps the discount. So there are some concerns that if the discounts become large enough, it could make economic sense, right, for the companies to sell off their digital asset holdings and buy back shares. So that could also have weight on a crypto market sentiment. But here it's important to stress that the market cap of all listed DETCOs is very small. It's about 115 to 130 billion dollars compared to the market cap of Bitcoin, which is easily 2.5 trillion, Ether another 500 billion. This is very small. So to argue that DETCOs has been a major reason why crypto markets sell, I think that's really a case of the tail wagging the dog, right? That's not too likely to be the reason. In fact, DETCOs probably are suffering because crypto markets are suffering. So by and large, the real reason, I think, given the fact that crypto market is not just really about traditional market factors, there's also a bunch of other ideas that are driving cryptos. And I think there are some technology arguments that have recently come to gather more attention. This could be also driving some concerns around crypto, and that's really what I'm going to talk about. So if you look at the market cap the monthly returns of Bitcoin, it's a very sharp 19 to 20% decline over the last month. Compared to S&P 500, where it's a very small decline, it's very hard to argue that the market factors that we raised earlier is the major contributory factors for this negative returns. We think another factor is at work, and here we will talk about the quantum risk, right? So called the quantum menace. It's well known. Quantum computing, they can perhaps crack.
William, just 1 minute. Before the quantum, I just want to finish the thread on the Bitcoin sell-off. Okay, so let's just go back to your earlier slide. I have posted a couple of things on the chat group related to the $15 billion seizure by the U.S. authorities, U.S. and UK authorities, of these Prince Group, scam-related activity and the $15 billion in crypto. One thing that is still not clear to me is, how did the authorities manage to do that? How did they get the keys of these wallets? Because the person in question is missing in action. Americans are looking for him, but he may be somewhere in the world with a fake identity. But somehow did the American spy agencies successfully hack into the crypto wallet of this Cambodian gentleman?
Well, so the U.S. authorities have not really given any explanation to how they did that, right? So some of the Chinese computer analysts, they're saying that it is a hacking attempt. It could be because they don't need to crack the actual key. They could, for instance, be make smart guesses about password to your computer. They can connect to your computer, and that's probably lower level encryption, right? If your password complexity is not high, so a smart analyst will be able to figure out what the possible combinations of a computer, and that perhaps could give them access to a wallet. So it's really speculative over here. It's very hard to argue that yet the spy agencies have some secret means to crack Bitcoin or Ether encryption, because this encryption, they are based on the highest most advanced cryptography techniques in use today. They're based on something called the elliptic curve cryptography, and it's expected to take classical computers thousands of years to be able to successfully crack the secret private key from the public keys, even if that's disclosed. So I don't think it's as complicated as throwing computer power into um, into instilling a into cracking a private key, but more of a case of some careless password management issues, or perhaps some of the means that the authorities have taken advantage of to hack in the system. So nobody knows for sure. I think it'll be a secret that will persist for some time.
It is extraordinary. And the reason I bring that up is for a variety of reasons. Number one, the keys are supposed to be impenetrable. But to your point, that if you've written it down in a Word document in your computer, and that computer itself is very easily hackable, then I suppose nothing is that sacrosanct. It is nonetheless $15 billion worth of crypto. This is the largest ever seizure ever. Just to give the people on this call a sense of proportion, that is 30% of Cambodia's GDP. It's that huge. And it's already taken down a deputy prime minister in one country. It has led to this huge company. It's a conglomerate, Prince Group. It has hundreds of companies underneath, if not dozens, and they have all been frozen and under sanction. Dozens and dozens of people are under the sanction. So you point out 1010, the intensification of China-US trade issue, after which we immediately begin to see some risk off on the crypto side. To me, this event, which happened the following week, the second or third week of October, also seems to be a pretty big dampener in the enthusiasm of the crypto people in the world. See, I read stories every month that the drug cartels in Latin America are using crypto-based ways to, move their money around, so money laundering. U.S. Treasury reports on a regular basis that every month, $1 billion or so in ransomware or hackingware or something or the other is being lost by Americans only, right? We also have stories in Singapore. The Singaporeans are very gullible toward scams and have to, at the end, pay some sort of a ransomware. Seems to me that the common thread in all these activities is that they end up taking the funds in crypto. Now, this year, as we said earlier, was supposed to be the year when, with the US government change of scenery, that the Trump administration is very crypto friendly, very light touch on regulation. But after all that, it is the Trump administration that has done the biggest seizure of crypto assets in the history of cryptos.
So that's an irony in that, but I would say this investigation probably predates Trump, from what I read, but it is what it is. So there is definitely some concern, especially if for those with ill-gotten crypto gains, they could be looking maybe a little bit more closely at their passwords. All right, so okay, I think generally speaking, the idea of security in crypto and blockchain is considered a very important topic, but by and large is not necessarily a market mover for the month or for the year. But now, going into end of 2025, there actually is a lot more questions on quantum. So just by talking to some of our clients, we hear questions about quantum more often. Um, even when we first started covering crypto in 2020, there was a session where, someone asked us about risk from quantum computing, and then we were quite confident in saying that no, it's not the case. That cryptography will be cracked so easily. But now, today, it's starting to look a little bit less certain. If you, for instance, look at the odds offered by Metaculus, which is one of the prediction markets provider, they ask a question: when will a quantum computer running Shor's algorithm, which is essentially a quantum algorithm, be used to factor a RSA number for the first time? So RSA is kind of an encryption um, algorithm. So to be able to factor them means that you have gone a very significant way to actually getting a private key out of the public key, cryptography. So the estimates based on I would imagine a very wide and widely read and technologically sophisticated group of people, is that it could happen in May 2034, right? That's just about 9 years. But if you look at the probability distribution, actually it skews a lot more to the left. So sometime a few months ago, Ethereum co-founder Buterin said that it's actually based on this odds, 20% chance that quantum computing could crack modern cryptography by 2030. So that's just 5 years from now. And the state of quantum computing is actually changing pretty fast. The reason why I would say that is because quantum computing is being seen as an enabler for better AI, right? So now AI investment in AI is literally in the trillions, and perhaps that amount of investments could also come into play into accelerating quantum hardware development. So no one knows. It is a matter of scientific progress and engineering, but there is this risk that quantum computing could become a lot more powerful, a lot more fault tolerant, that they could essentially be in a position to threaten encryption based on today's cryptography. But moving on to blockchain, how does this actually relates to the Bitcoin Ether, right? So I think we just kind of explain a little bit about how Bitcoin transactions actually work. This will give a better idea of why the secrecy of private key is important. So essentially, when a transaction happens on a blockchain, the owner of a Bitcoin will have to sign a transaction to be broadcast to the network. So he signs it with his private key. Only he knows. It's linked to this address via hash function. But by and large, because of the asymmetric one-way cryptography, it's very easy for a validator to verify that the signature is valid based on the public key, but it's impossible for them to actually back out what the private key is based on the signature, right? So the signature is encrypted with the so-called elliptic curve cryptography. It is estimated that it will take essentially thousands of years for classical computers to even have a chance to do that, to elicit to what the private key is. But because of quantum computers, and there's this famous algorithm called Shor's algorithm, which shows that the quantum computing could essentially solve this class of problems known as the elliptic curve discrete logarithms problem relatively quickly in polynomial time, which means that it's essentially shrinking the degree of computations needed. The reason why quantum computers can do that is because they not only represent data as 0 and 1, which is the classical format, but they can represent it as a superposition of a mixed state between 0 and 1. So that allows it a lot more power to handle such problems. So if a private key is discovered, then essentially any attacker can sign transactions on the blockchain, and it will be very difficult for security to be maintained. So there are some ways the blockchain has been designed to mitigate certain threats. So for instance, public keys are no longer exposed until a transaction happens. But a transaction needs to happen before any reasonable attempt to crack the private key succeeds, right? So if an attacker really successfully obtains a private key, he can choose to raise against the owner to implement his transaction on the blockchain. So there is this degree of risk that quantum computing poses to the entire transaction mechanism that was first proposed by Satoshi Nakamoto in this Bitcoin paper. And as I mentioned, the why is quantum computing coming to consciousness again? This is a technology that has been discussed many times in the past. I think we cannot really run away from the fact that there's massive focus on AI research. So the US actually is pouring significant resources into AI. Now the White House has launched the Genesis mission, which is actually intended to accelerate AI research. And under the mission, they have labeled quantum information science as a scientific domain of national importance. So that means more resources and more scientists is probably going to be working on this problem. We could see the private sector stepping up because quantum information science is seen as a possible enabler to better AI, right? So this is beyond my level of expertise, but it is believed that the computations that's needed for AI is actually very amenable to quantum computers. So it could be the case we could see an acceleration in quantum hardware. We could see hardware that could threaten encryption. Maybe not immediately, but there's a chance that it could happen within the next 5 years. Um, so what is being done about this quantum encryption risk or this quantum computing risk? So there are initiatives by the US, NISC, the National Institute of Standards and Technology. They have started a review of quantum resistant cryptography to try to standardize some of the quantum resistance methods that could be used. It's known as post-quantum cryptography, PQC. So there is reason to believe that mitigations efforts could succeed, right? So the other thing to note is also the fact that that really quantum computing is really a domain for very well-resourced sectors. For instance, nation states, for instance, large corporates. It's not going to be a case where a individual hacker is going to get access to a powerful enough quantum hardware to threaten encryption. So existing legal protections or to deter against computer attacks, those can be strengthened. And also, we all know that Bitcoin and Ethereum networks, there is a history of reaching social consensus across developers to try to bring upgrades to the network. So if and when quantum computing becomes a risk, it's also likely a case that the networks will start adapting the new so-called PQC algorithms to secure them. So quantum computing, yes, it's a risk, but also do not discount the fact that with more attention on this front, there's likely to be plenty of runway for mitigation efforts to accelerate and to try to insulate the blockchain from any risk related to encryption.
William, there are a bunch of questions from Jiten. He sent to me privately, so I'm going to read it out to you.
Sure,
But
sure.
also, Purnima, I see that you have your hands raised. Just type your question in the chat section, please. I think that's the best way we can handle the questions. All right. The questions are related to cryptography. So first question is, wouldn't cryptography get involved by 2034 to make it more difficult to crack? I think you've sort of addressed that question already, but just repeat that. If RSA is broken, how could Bitcoin be perceived as a store of value in the long term? And then wouldn't that bring the Bitcoin versus gold argument back anyway? So on the Bitcoin versus gold argument, you and I were discussing the issue of Bitcoin as a currency earlier. I'll talk about that later, but I would like you to sort of go through the first two questions again. Cryptography, can that evolve? And secondly, if RSA is broken, then how can Bitcoin be perceived as a store of value in the long term?
Right. So cryptography can certainly evolve, right? So as I mentioned, a lot of this cryptography techniques, they are based on a mathematical research. And if you think about it, the algorithm that was designed by Shaw was actually published in 1994. So it's not that old. So cryptography has evolved as mathematical knowledge increases, and right now, based on the current understanding of technology, based on the current um, capabilities of quantum hardware, essentially the mathematicians are saying, you can still rest easy. Cryptography is still very much uncrackable. But going into the future, no one knows what the future will bring. So necessarily, a lot of research is being done. So as I mentioned, the US NISC is not sitting on its hands. It is actually actively reviewing some quantum-resistant algorithms, and they have published a short list of algorithms for further review and potential implementations. So by and large, the security community is working on this problem. We see essentially it's an engineering issue. We don't see it as any fundamental flaw in cryptography. It's an engineering issue to bring about new techniques in response to evolving knowledge about how computers can work, especially in this case, quantum computers. The second question, store of value. In a way, if you think about it, gold as a store of value is also vulnerable to attack, right? So that in the past you had to store gold in a vault, you had to invest money in hiring security guards. Um, uh, every asset can definitely be attacked to some extent. It's just that digital assets, they live virtually, they live on a blockchain, so they are vulnerable to a new vector attacks that they are not really present for physical assets. So in this case, they're vulnerable um, to hacking, vulnerable to the loss of private keys, among other things. But if security is taken seriously, if for instance there is proper custody of digital assets, if there is proper measures taken to ensure that public addresses are not unduly exposed, if there are uh, best practices around transactions are followed to prevent the leakage of actively used public address, then actually that goes a long way in securing digital assets. So I don't think that is naturally that's going to detract from the argument that digital assets can be a store of value. It's just that there's really a lot more security implications, security measures to be taken to protect these assets.
Now, on the gold versus Bitcoin issue, it's kind of amazing. Again, Willie and I have both been working on this issue for 6, 7 years, if not longer. And of course, global regulators like the BIS and the IMF have been thinking through the monetary implications of a ubiquitous crypto asset like Bitcoin. But one question that has never really been raised until recently, one of our peers, Paul Donovan, who's the chief economist at UBS Wealth Management, he wrote an article recently, and William and I were just discussing this thing. It's a very basic first principle question. You see, when a normal currency is issued, like the US dollar or the Japanese yen, the authorities have the tools to match supply and demand. If you have a situation where there's a lot of inflation in the economy, you can raise interest rates to reduce money demand. You can do QT to, start selling assets to take cash out of the system. You can do money market operations. Similarly, when things are very weak, money demand is very weak, you can cut interest rates, you can inject liquidity, you can print money, and so on. And Paul's point is that the crypto world, particularly Bitcoin, given its algorithmic fixed quantity of issuance, is simply incapable of doing that. You could argue that Bitcoin has a fixed number of coins. Ultimately, after 21 million, there'll be nothing issued. But regardless of when the issuance stops or what the ultimate number is, the fact of the matter is there is no authority there to match supply and demand for Bitcoin in any situation, in under any circumstances. By definition, over time, Bitcoin supply increases till it hits the 21 million cap. Unlike the US dollar, where during the pandemic, huge amount of supply. After the pandemic, when inflation picked up, massive contraction in supply, the Fed tightened monetary policy. Going into 2026, again, we probably will see neutral stance with respect to US dollar liquidity. And if the US economy slows, the Fed might even inject more liquidity. None of those things are possible in the crypto definition or crypto framework around Bitcoin. I am sort of shocked that such basic first principle discussion hasn't really happened in the past. And both William and I keep a pretty close tab on the whole discussion at the academic and the practitioners front. But I think Paul Donovan has stumbled upon something rather profound. It is true that this is a key differentiating factor between traditional fiat currency and the crypto universe, particularly Bitcoin, where there is no question of supply ever matching demand. Supply does its own thing, demand does its own thing. Now, William, we don't have Radhika on the call yet. Maybe she's not being able to log in. I think you might have to pull us through the rest of the presentation.
Sure. So I'll just quickly go through the remaining parts of the presentation. So the first point to note is about the prospects of crypto collateralization. Then I'll cover stablecoins in the last part. So what is crypto collateralization, right? So can digital assets be used as collateral for loans? Interestingly enough, we might be looking at the possibility of that in 2026. So media reports recently indicated a large US bank they are considering expanding collateral eligibility beyond Bitcoin ETFs, which is a well-known financial market instrument, ETFs, right, to Bitcoin itself, which is the token. So what are some of the reasons why traditional banks are looking to do that, right? So I think there are some good commercial reasons. So we think, firstly, there is a trend of rising adoption of digital assets across high net worth investors. So a study by the Journal of Financial Planning shows that about 3% of high net worth investors have allocated even high net worth investors allocated about 3% of their portfolios into digital assets, and actually among the younger people it could be as high as 15%. So the skew of adoption is very much to the younger crowd. So businesses being businesses, they know that you need to be looking out for the younger clientele. So no surprise, we see interest in providing financial services to this crowd with very high interest in digital assets. And just to get a sense of the market opportunity, right? So let's have a conservative estimate, $1 trillion worth of digital assets capitalization. Assuming banks can give about 50% LTV and they charge about 10% margin on those loans, conservatively, that's about 50 billion worth of interest income per annum opportunity right out there. So that could be a strong reason why banks are looking into this space. And the second reason also has to do with the fact, as we mentioned earlier, the risk profile of Bitcoin Ether, they have improved very, very significantly over the last 5 years. Liquidity is a lot better, as demonstrated during the 10-10 wave of crypto liquidations, right? You don't see very large 50% losses on a single day. That could be partly due to very high degree of institutional participation. So these are people, or rather investors with the ability to set proper prices. They're able to come to market to support if if there's an opportunity for them. So that's one reason why investors or institutions are looking into enabling Bitcoin Ether collateral because the risk profile has improved so much. And what are the implications for the digital asset market? So there are many studies done in the past about what collateralization can do for assets, for instance, for bonds or for property. So researchers found that when banks accept real estate as collateral, what that means is that you could see about an additional 4% premium based on for premium for real estate assets in Texas. In the case of bonds, when a bond becomes eligible collateral for ECB facilities, there's also an increase in the valuation premium. So by and large, this increased financing possibilities based on Bitcoin and Ether collateral should improve their valuations. It should also bolster their liquidity. But at the same time, there's also a risk of increased leverage based on collateralized loans, right? So there are also studies that shows that financial market volatility, asset market volatility tends to increase with higher degree of collateralization. So it's a bit of a double-edged sword. You do get a bit of an uplift in terms of prices, in terms of valuations, but at the expense of perhaps higher volatility with this trend. So I think Radhika is online, so I will just be happy to pass the section to her if she would like to speak. Radhika,
Hi,
can you hear me?
Radhika. She's on mute. I wonder if she's like in the middle of some traffic or has some difficulties connecting with us.
Yeah, so maybe I'll just talk a little
Just
bit
continue.
about
Yeah, just continue. When
stablecoins,
she
and
joins in, she'll
when
join
she
in. Yeah.
joins in, we'll let her speak on that. So I think stablecoins essentially they're still growing very fast, right? So when we first broached the topic, stablecoins were market cap was around 250 billion in the August version of Digital Assets Quarterly. Now they're about 300 billion. So in the span of maybe 3 months, they've gone up about 50 billion increase. So the pace of adoption of stablecoins is pretty fast. And partly that's to do with the better legal status under the Genius Act, where it is actually recognized as currency and given protection with regards to having, for instance, higher priority in claims during a bankruptcy. In fact, U.S. law was changed to allow uh, stablecoin claims to rank even higher than employee claims or traditional claims that rank at the top of the creditors hierarchy. So that has, I think, to some extent, be supportive for adoption of stablecoins. Also in China and Hong Kong, um, there's a lot of attention on stablecoins, right? So Hong Kong has passed the stablecoin ordinance. So they are due to issue a couple of licenses to stablecoin issuers in 2026. Essentially, they'll be looking at doing some pilots, experimentations, to see what the use cases are for stablecoins. Given that stablecoins really help to reduce friction in cross-border transfers by making such transfers, firstly, very cost efficient, secondly, very transparent. So there's a lot of scope for these stablecoin transactions to take off in terms of supporting cross-border transfers for retail, for corporates, and for other investors as well. In terms of the level of transactions, actually those have also increased very significantly. So Visa does a monthly tracker of stablecoin transactions on the blockchain. And you can see from a very steady pace of growth between 2020 to late 2024, we've seen essentially an exponential growth uh, for stablecoins transactions. So by and large, transaction volume has doubled in the last year, from about $600 billion a month in early 2025. They're now easily about 1.4 trillion transactions on the blockchain. And the interesting point to note is the fact that much of that growth is not necessarily driven by what we think as retail transactions. It's actually driven a lot by crypto trading. About 80% of stablecoin transactions, they are linked to very large very large dollar transfers. So they are indicative of essentially crypto traders moving funds from moving money from their crypto Bitcoin Ether holdings into fiat currencies represented by stablecoins. Only about 20% of these transactions qualify as small value transactions, which could reflect actual usage in terms of transactions, real world transactions between different parties for commercial transactions. So at this point in time, stablecoin is still not widely used, for instance, in retail payments. So whether that will change in the coming year because of an increased issuers of stablecoins with the new legal regime, time will tell. But it seems that with more interest and also with the fact that the technology can scale pretty easily. If you look at the volumes that were done on in stablecoins compared to the annual volumes by Visa and Mastercard, the stablecoin transaction volumes has already exceeded the combined annual volumes of the two major credit card processors. So no reason why technology is constrained for the growth of stablecoins. So other discussion points on stablecoins, what are the regulatory impact of this on banks? So a lot of concern with regards to potential deposit outflows, right? So if money is moved from banks to stablecoin issuers, then that would obviously affect the deposit base, raising the cost of deposits, making it a bit more costly for banks to extend loans than in the past. So there are a few concerns on this front. But essentially, because stablecoins do not attract interest, then there is also a natural limit into how much money would people want to put in stablecoins, because compared to putting in traditional deposits, you're earning interest. Stablecoins which are non-interest bearing is relatively less attractive. So for now, I think regulators are keen to make sure that intermediation function of banks, they're not threatened by the introduction of stablecoins, and by and large, it seems that they are not really at risk over here. But it could be a different play if the stablecoins can offer various incentives that could be similar to interest payments to try to lure users. So that's that's something that some of the regulators and industry players are also looking to. In the UK, I think there has been a mindset shift in terms of the acceptance of stablecoins. So in the past, Bank of England was relatively reluctant in embracing stablecoins because uh, uh, it's not clear what the use case for stablecoins are. But there has been a bit of a shift in terms of policy rhetoric. Bank of England are moving in terms of encouraging, perhaps looking to introduce more stable coins uh, 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 to allow more space for stable coins to grow within the UK. So that's an area I think that would probably be where other countries are looking closely at. So in Europe, there's still a lot of policy bias towards supporting a Euro CBDC. Um, in fact, Christine Lagarde has mentioned that the CBDC efforts will be increased and that there could be a further accelerated pace of development. But at the same time, the industry is also saying that don't completely rule out stablecoins, also allow stablecoins to be an alternative, privately managed pathway for payments besides CBDC. So that's still a degree of tension between what we call private sector players versus the public sector.
Um, William, let me add 2 points here. Issue number one is the risk to two aspects of banking. One, William has already touched on. Let me just elaborate on that. It's the issue of correspondent banking. That right now, banks manage liquidity, they do payments vis-a-vis other bank for trade finance, for cross-border settlements, and so on. If stable coins through non-bank financial sector start taking that business out, then of course there's a disintermediation risk for the banking system. The second risk for the traditional financial sector is the disruption that might come through remittances. I have mentioned this in the past, probably not in the context of a digital asset webinar, but I don't see why a foreign worker sitting in Singapore in the future would want to send money home through the traditional banking or non-bank payment system like a Western Union, the way they have in the past, because they probably will have a digital solution, which is a stablecoin based one, where they can send to their loved ones basically foreign currency. And their loved ones sitting in their countries can completely circumvent central bank capital control measures and currency surrender requirement, foreign currency surrender requirements. And and as a result, these central banks could potentially lose control over money supply of foreign currency coming into their own country. So the implications are profound, and I don't think central banks really have a solution there. My prediction to one developing country central bank recently was twofold. I said that by end of 2026, you will ban the use of stable coins in your country. That's prediction one. And prediction two was that will be futile. That even if they ban it, people will still use it, and they really will have no way around it. So those, I think, are the big risks out there. The third risk, I said two risks, but there's a negative aspect as well, which is a governance issue. Because with the Genius Act, the US has gone sort of all in with very light touch regulation. And we understand that in 2026, as the Fed leadership changes and becomes more Trump friendly, we might see other regulatory changes, which again make issuance of stable coins and settlement around that by non-bank financial companies easier and easier. The fear is that there will be some governance lapses here and there, which actually might end up damaging the asset class instead of reinforcing them. So that's a double-edged sword. If you do too much regulation, the asset class dies. If you do too little regulation, the asset class might become too risky. So that's the trade-off that I think the US government right now is sort of oblivious about. The Europeans worry a lot about, and the rest of the world simply is a bystander. There's not much solution out there in place. William, do we need to go through the regional initiatives, or do we just encourage our viewers in the call to read that in the report and wrap the call up?
Sure, I think these regional initiatives are well covered by Radhika in the report, so we'll be happy to take questions from anyone in the audience um, from this for this call.
Right. or else, we just wrap up a call. We're on the 51st minute mark. We have covered the major bases. So in case there are no more questions, thank you very much, everybody, for joining the call. We'll make the recording available later, and do read the report. It's got some excellent piece of work, research done by Radhika William and our colleague in equities. So until then, everybody, take care and have a great day.